Hey, this is Colin Nathan. I'm the real estate boy, and welcome to Real Estate with Soul. This is a stream that I do every week where we look into the lives of Black real estate professionals. So today, who I have on as a guest, all right, this is Andrew Thompson. He is a loan officer with Cross Country Mortgage. He's based in New Jersey, but I know he does more states than New Jersey. So welcome to the live stream, Andrew.
Thanks for having me, man. I really appreciate it. Pleasure being here.
All right, cool, man. Cool. So we just want to dive into as far as Andrew himself. And because a lot of realtors, a lot of people just in real estate, just in general, look at this program. So we definitely want to put your skills on display. So you're a loan officer now. Why don't you tell us about your background? What did you do before becoming a loan officer?
Oh, well, before becoming a loan officer, I was in sales for a couple of years. And then one of my clients at the time actually gave me an opportunity. One of his friends was opening up a warehouse in Pennsylvania. It gave me the opportunity to, become a manager over there. I ran that for a couple of years. And I kind of, got out of that industry. Was looking to get back into sales. I had looked into being into real estate before. And I kind of weighed out the pros and cons of being a loan officer or becoming an actual real estate agent. Um,
Okay.
and Loan officer won out. The reason why I got into the industry. It was because I was seeing a lot of my friends and family. They were looking to apply for mortgages, and they were just having so many struggles. Either dealing with the loan officer they were working with, or finding people that would give them the information. People that were struggling with credit issues. So I was real big on, just trying to help, people that were around me and, getting the information that I had. I was like, well, I enjoyed it. Why not do this and help the community out?
Okay, cool. And what markets do you actually service? What states?
States I mainly service: New Jersey, Pennsylvania, Delaware. Previously, I was licensed in about 44 states. But a lot of companies, don't want you to, have them lingering around. But I can service nationwide. So I do loans all over the country.
Now, question, because for real estate agents, if I want to get licensed in other states, I have to take a test. Is that
Mhm.
the same thing as a mortgage, a loan officer?
So we have to do when you get your loan officer's license, you have to pass what is called the UST. It's the United States Test for Loan Officers.
Okay.
And once you pass that test, every state has their own education that you have to take in order to get your license in that state. So New Jersey has a 2-hour course. Pennsylvania has I think it's like a 3-hour course. Some states don't have any course, and when you pass that UST, you automatically qualify for that state.
Wow.
So yeah, every state does have their own individual education that you have to take when you get that initial state, and their continuing education you have to take every year. But what we do here at Cross Country Mortgage, we have what's called a referral desk. So, say if I have a client, or I meet somebody when I'm on vacation, or if I have people that live across the country,
Mhm.
we send that file to a referral desk, and that person on the referral desk is the one that works the file alongside of me, because that loan officer has to be licensed in that state. So they do the work as far as locking the loan. But as far as doing the structuring and things of that nature, we take care of here, at our office here, and we're able to service our clients wherever they're needed.
Okay. Now, why'd you pick cross country to work with?
Cross country has a little bit of everything for everybody.
Mhm.
Um, it's very important in this market right now to be as versatile and to be as um, I'll say product savvy as possible. There's a lot of clients out there that have a bunch of different situations, so, I deal with clients that, really don't have, too much, money to put down on the property, or they just get started up with the credit, they don't have too high credit scores. And then I get clients that, have high value, high assets, and, they're not looking to spend any money out of their pocket. They're just looking to, purchase a property off the strength of, hey, I've got these assets built up. Can you qualify me based off of that? So Cross Country has a wide range of products that allows me to service everybody that I encounter. So we have FHA loans, VA loans, conventional loans, and we have a whole department that's dedicated to what is called non-QM. Non-QM loans are what a lot of investors use and a lot of people that are self-employed use to purchase property because they're not traditionally qualified in a traditional mortgage box. They may have only been self-employed for a year, so we have a program for that. They may write a lot of stuff off during the year, so we may be able to use a bank statement loan for them. Because they'll show all their deposits that are going into their bank account. We can use them as their income versus just using a traditional W-2 employer. So, we have down payment assistance programs that we're affiliated with as well. So, when I was weighing out the pros and cons of different companies, I came across cross country, had a good conversation with them. The rates are hella competitive. It's rare that, we get beat out on an interest rate. The servicing time, our underwriting is 24 hours. We have a 14-day close process. If we get you pre-underwritten, we have what's called our fast track program. So, if you come to me, get pre-approved, we have you sign some documents. We'll fully financially pre-approve you and get you underwritten. So when you go with your pre-approval out shopping with your realtor, it'll say, hey, this person can close in as little as 14 days. All we need is title work and the appraisal done because we've already vetted them financially. So
and that's important. That's super important because it's almost like having cash when you're going out there and you're trying to compete with other offers out there.
Absolutely. And that's what we see in a lot in the market, especially for clients that you see a lot in this market. Some people will fall through on a deal, and the seller of the property was like, well, I needed to close on this to close on my place. Can you guys close in 20 days? Can you guys close in 15 days? And that's something that is extremely crucial, in this type of market where things are moving so fast, properties are going so fast. People that need to really get moving on things. So I find it to be an extremely handy tool.
Now, as a mortgage officer, have you seen any change in your business since the Fed has been hiking rates up these past couple of months?
I haven't seen a difference in my business. There's a difference in the mindset of people that are going into the mortgage market. So, they hear, again, the Fed is raising interest rates. So they automatically think, oh, the Fed is raising mortgage interest rates. And the Fed isn't directly, correlated to the mortgage interest rate. That the Fed that everybody hears about is the bank-to-bank lending. That's not directly with us. Now, again, will we be affected inadvertently? Absolutely. So, people are coming in asking more questions. They're actually looking, well, maybe I should hop on this before rates get even higher because interest rates are in that 5% range. Investment, interest rates are in that 6% range. Right. So people are, all right, I should have done this last year, but maybe I should hop on it now, even though there's competition in the market because I don't want to end up with a 7% interest rate if it gets there, Right. Some people, but again, some of the people are waiting. They're saying, "Oh, the market's going to crash," which it's a lot of fear from the 2008 that we had a couple years back that really is putting that negative message out there.
Right, and that's funny because I had read somewhere that during the Great Depression, that people of that generation, they never really bought anything after that because they were always waiting for that Great Depression to happen again. And it never happened. So you have some people who are still gun shy now who think this is a repeat of 07, 08, and 09. Yeah. And it's like, oh, it's going to be. But I mean, if you ask me personally, I definitely don't think that we're going that route. Number one, the builders haven't exceeded the demand. So we don't have a lot of access houses. That's number one. Number two is that your industry kind of learned their lesson and the standards are not falling. So people still have to verify everything. So the standards aren't back. I don't know if you were in the business back then, but they had this company called Countrywide. And as long as you can breathe, Countrywide was giving you a loan. So you had that, and there was one more thing. I can't remember what it was, but because of that, I don't see us going to the same place. Maybe prices might flatten out, but to go down like they did last time, I just don't think it's going to happen. What's your opinion as far as where the market's headed?
You hit that right on the head. I definitely feel there's going to be a level out. We'll probably plateau, but I don't see us crashing. For a couple of reasons. One, that what you said, again, builders haven't met demand. Back in 2008, we had a double crisis there. The financial market was in disarray,
Right.
as was the mortgage market. And back in 2008, we had ample supply.
Right.
So there was housing available. And again, like you said, there was people that were, if you had a pulse, I'll give you a loan. So
Right.
at the end of the day, it was bad back then. We were in a totally different position. We were completely unregulated, so it was the Wild Wild West. People could do whatever they wanted to. We're just not in that position now. So do I think it's going to level out? Absolutely. Do I think we're going to go into have a crash? No, not in the least bit. I mean, there's too much. Again, even with the inflation that's in the market in the country in general right now, product prices of goods are going to go back down, but they're not going to go back to pandemic levels.
Right.
They're not going to go back to 2008 levels. That, like you said, with the Great Depression, people were holding off. Oh, I'm just going to wait. I'm going to wait. I'm going to wait. And they weighted themselves into, I've got to spend more for what I wanted, because you should have just grabbed it by the heels then.
Right. The other thing that I was thinking about is that during that time, a lot of people were using their HELOCs like ATMs. So they were just going in there and taking a lot of money out, but a lot of people aren't doing that. A lot of people, they owe less than the equity that they have in their property. So they may be able to kind of wait this cycle out. But have you been seeing an increase in people using ARMs? And for those of you who don't know, they're adjustable rate mortgages.
So I've seen an increase in people asking about ARMs.
Okay.
I do feel that there are ARM products that are going to be valuable to people. And those ARMs, I think, are anywhere from 5 to 10 years on those ARMs, because with the volatility in the market, there is no telling where we're going. But again, historically, we have an up or down tick, every 5 years or so. So if you take a risk on a 5-year ARM, and in 5 years, again, the interest rate market has either dipped or stayed in the same position, refinance out and ride your mortgage out for the rest of the time that you have it. Or again, if you're just looking to stay in the property short term, of course, go with a 5-year, 7-year ARM and ride it out that way. But do I think they're a stable product if you're looking at a 3-year ARM? No, I don't think that's something that will be wise for you, because again, there's no telling that, because of where everything is, there's no telling where we're going to be in 3 years.
Right. Now, do you guys have this 40-year loan product?
Yeah, we have those 40 years interest only. We just got wind of a product that we've been offering for a little while, but it's more prominent now. And no income verification. As long as you have a 720 credit score, and the money for the down payment, you can get a house. So it's those type products. Again, they are pre-2008 esque. But that is just because of the confidence and the regulation that's been out there, and the consumer spending as well. Consumer spending hasn't dipped at all, right, across the country in a market or anything like that. So the only thing that has increased, which I thought was an interesting statistic, was consumer credit that increased significantly between March and April. And that's when a lot of those government programs dropped off and everyone's having to start using their own money and everything like that. So I think there's going to be a huge market right now for HELOCs, home equity lines of credit, cash out loans, things of that nature. Because again, people are getting their backs up against the wall again, because their debt is increasing, and they're having to spend their own money now versus pandemic level times when they were getting more assistance and things of that nature.
Right, that STEMI.
Yeah.
No, I understand, man. So taking, millions of applications, man, what's probably the biggest 3 mistakes that you see people make when they apply for a loan?
Biggest mistake I see people make applying for the loan is lying on their application.
Okay.
there's a saying that buyers are liars. Not all of them, but
Right.
buyers will tell you what you think you need to hear.
Right.
And my message on most people, when I have that first conversation is, listen, I'm your last line of defense before you file a seasoned underwriter.
Right.
So you need to be a completely 100% honest with me so we can find a solution if you have a problem. So, people, I had a lady one time didn't tell me that she was married before.
Oh, okay.
Came up, later on in the process and everything like that, found out that she was married and they needed her husband to sign something at closing. Her husband lived overseas.
Oh, wow.
Yeah. Yeah. So silly things like that, can ruin your loan process and completely tank your loan. I think the second largest thing is people, when they're filling out applications, is waiting to fill out that application. People will often tell people, oh, if you don't have money saved, don't apply for a mortgage. If you don't have the money saved, don't apply for a mortgage. No, you need to find out what you would qualify for if you had the money. You need to set goals. So a lot of people will come, when their back's against the wall, oh, I've got to move in 3 months. I got to move in a month. And they don't have any money saved.
Right.
Oh, I didn't know how much I needed saved. But if you came to me when you had the notion the first time and said, hey, I want to buy a house. I need to know if my credit's in line. I need to know if I got enough money, what kind of programs I'll qualify for. I can reverse engineer you into getting a property in 3 to 6 months. But if you come to me at the end of your situation,
right.
That's the biggest denier of loans, I think, for me, is people that waited too long. People that have priced themselves out of the market now because, again, interest rates were at 2% last year, and now they're at 5-6.
I got about 2 or 3 people like that, and it was just like, hey, we were looking for homes, but it kept being too picky. But I want to talk about what you said as far as people not coming to you at the last minute. I had a young lady yesterday, and she had to get her credit pulled to see. Well, she spoke with the loan officer, but she didn't want the loan officer to pull her credit. And I'm telling her, well, listen, this is something that you have to do. Like, don't be so scared of getting your credit pulled. Yes, your credit score will go down a couple of points, but that's kind of the least of your worries. You got to see, the loan officer has to see what your credit is, and so they can set you up the way that you needed to be set up to see, can you do this? Because if not, you'll constantly be on the sideline wondering what's the temperature of the pool.
Yeah, 1,000%. And what you said right there, I mean, especially if you have bad credit, your credit's not going to get that much worse by us pulling it. At least we have the tools and the knowledge to tell you, hey, yeah, you're in a bad spot right now. But I'm working on a deal right now. Girl came to me. She was like, yeah, I was working with 2 other lenders. My score is a 498. They told me to do X, Y, and Z, and that's why I dropped. And I'm really, I'm under contract. I need to figure out how to do this. So I pulled a credit, took a look at the situation. I said, hey, you need to call and get these late payments removed. We need to pay this off. And we can get your score to that 580 mark. She did everything I told her to do, got a score up to 580, and we're closing in 2 weeks.
Nice.
But again, because people are afraid a lot of times, or people don't see the value in, all right, I know I've got to do this. It's almost like investing in property. You got to put out to get something back. Right. So you got to give me the information so we can get you what you want back. You want a property, you want a house, you got to take that step.
That sounds like you're blowing up over there, man.
That's my daily, man.
Okay.
But yeah, so that's huge, man. Like, people that don't want to get their credit pulled, and again, there's the opportunities where some lenders have the opportunity to do a soft credit pull for you, and soft credit pulls, they will tell you what the scores are, but they won't tell you what you need to do to fix it. And again, it still shows up on your credit report, that you had a credit pull and everything like that. It's just not a hard inquiry.
Right.
So my message to those people. So, bless you.
It always happens once I start talking.
No, that's okay.
As long as I'm quiet, it doesn't come, but my allergies. my allergies, they come as soon as I start talking, they'll come.
Mhm.
And it's like, look, why don't you do this when I'm not on live stream?
Right.
But in any case, man, well, what I wanted to do is jump into how much a loan costs. Because when I'm dealing with different people who are looking to buy a home, they're always like, well, how much money am I going to need? And I think people get confused between the closing costs and the down payment costs. So
Hmm.
if you can just elaborate on the difference between the closing costs and the down payment costs.
Surely. So your down payment is the requirement for your loan type. So if you have an FHA loan, the FHA requires you to put 3.5% down on that loan product. So that is that's your required investment for the FHA. Closing costs themselves are the costs that it takes to do all the title work and all the other intricacies of your loan. So that down payment is going towards your loan balance. The closing costs are going to entities. So the appraiser, the title company, the lawyers, real estate agents, to get your flood certs, to get your lender's title insurance, your owner's title insurance, all of the documentation that is done on the loan, that is what your closing costs equate out to. Closing costs are also a portion of your escrow account. An escrow account is what we establish for you to pay your taxes and your homeowner's insurance. So whenever we do closing costs and we're establishing, they're called prepaid items. So prepaid items are going to be your homeowner's insurance for the year, because when we do closing costs, we collect for a full year up front. So your homeowner's insurance is paid. And then we
Andrew,
also, sure.
hold on. Let me do this. Let me just let me bring this up on the screen here.
Okay.
And then it'd probably be better if you talk us through what I'm gonna do. This is a loan worksheet. And here we go. This is the loan worksheet. So right here is when you do go get a home, your lender should be providing you this to show you the details of the loan and also the financial details. So if you just want to walk us through this, then it probably will help the audience a little bit.
Surely. So again, if you can see up on the top there, at the top on top left, underneath where it says loan details, it's just going to show you the type of loan that it is there. It's an FHA 30-year loan, interest rate of 5.5%, purchase price at $300,000, and the loan amount is $294,566. So your loan amount, when we're talking about that down payment before, your loan amount is comprised of whatever the purchase price is minus your down payment. The only other thing that goes into that loan amount on an FHA loan is what's called your mortgage insurance premium. And I'll get to that in a second when we get lower in the sheet here. But you'll see down underneath where it says occupancy and property type in that same section, you'll see LTV, that's loan to value, and that says 96. So a loan to value is how much your house is worth versus how much your purchase price is. So loan to value, because the FHA's initial minimum investment is 3.5% of 100% of that home's purchase price. The loan to value will be 96.5%. So if we're going down to the actual loan cost down here on the bottom, excuse me, you've got the lender fees. So lender fees are going to be for your underwriting, your processing, the origination. All lenders have different fees. Some charge more, some charge less than what we do here across country. But that is something that most lenders do charge on their loans. You see a line underneath that says discount points. Now, I don't have any discount points here because that is what our rate is for the day without any cost. But discount points are when you have a interest rate that is lower than what is called the par rate. The par rate is the rate that lenders charge for the day or offer for the day that has no cost to the borrowers or the buyers. So a discount point is when you buy below that rate. So say that interest rate for the day is that 5.5. To go down to a 5.375 may cost you what is called discount points. And those discount points, you're charged as a part of your closing costs to obtain that lower rate. And what that does is it lowers your monthly mortgage payment so that you save money over the lifetime of your loan. which is a solid investment in most cases, because you can save upward to $28,000-$30,000 depending on the loan size. If we're going down a little bit further here, I said I was going to get back to the mortgage insurance premium. Mortgage insurance premium, that $5,065. The FHA charges a upfront mortgage insurance fee, which is 1.75% of the total loan amount of your loan. You don't pay that out of your pocket or as a part of your closing costs. That fee is financed into your loan balance, but it's charged on every FHA loan. It is considered a closing cost, but it's financed into the loan. Now, outside of that, again, the only other mortgage insurance that you do pay is monthly. And if you look up at the top right there where it says monthly payment, you'll see underneath the monthly payment, it says mortgage insurance, $203.81. So the FHA, again, they'll charge that upfront mortgage insurance fee, and they will also charge you a monthly fee as well. And that monthly mortgage insurance on the FHA does not go away unless you put 10% down on the loan, and you can get rid of it in 11 years. The only other way to get rid of that is to refinance out of that loan. But that's a topic for another day. We'll hop back into the book.
Hold on, because some people think, and I've gone I've gone round and round with people about this. There's some people who are under the assumption that it automatically falls off once you get 20% equity in your home.
That is the case if you have a conventional loan product. But if you have an FHA loan product, the only way to get rid of mortgage insurance is a couple ways. So if you put 10% down on your property with an FHA, they will allow you to get rid of it in 11 years. Okay. The only other way to get rid of it is to refinance out to a conventional loan.
Gotcha.
You put 3.5% down or anything less than 10% down, that stays on your loan for the lifetime of the loan.
Okay. Now, so they charge you this upfront fee, this upfront mortgage insurance premium.
Yep.
And they charge you this monthly mortgage insurance also.
Absolutely, because the FHA, it's the most common loan, and because they have a lower credit score requirement than most any other loan out there, they want that money is restitution for them in the event that you default on your loan. So they want, they're insuring and guaranteeing that loan for you, but that's that money that they want to get back in the event that you default on your property.
That's why y'all got to get your credit score up. That's why you have to get your credit score up. And I mean, just a shameless plug, I do have a credit repair company. So if you guys are looking at this and you do want to get your credit repaired, definitely contact me. We can do that. But go ahead.
Absolutely. Absolutely. Now, again, on the other hand, getting conventional products, conventional, you will pay mortgage insurance until you reach 20% equity in your property. Now, the way to go about that, once you've reached that 20% equity in the property, if you are at 80% loan to value, you can request it to be removed. It will only fall off at the 78% mark. So you always want to keep up what is called your amortization schedule. It will tell you how far along you are in your loan. And you want to know exactly at all times what the value of your home and the value in your neighborhoods are. So once you reach that 20% equity mark, you want to reach out to your lender and say, hey, I believe my home has reached the 20% equity position. I want to see about getting my mortgage insurance removed. And they'll tell you the necessary steps to get that taken off. But it will fall off automatically at 78%. Okay,
gotcha. And just a point, and you can tell me if this is correct, but I understood that with FHA, this is a blanket charge. They charge everybody the same amount, but with a conventional loan, it's based on your credit as far as how much they charge you for the mortgage insurance if it's under 20%. Is that correct?
Yeah, so it's definitely different for the two. So for FHA, with the upfront fee, they're charging you a percentage, and for the monthly fee, they're charging you a percentage of that loan amount. So if your loan amount is $300,000, they're charging you 1.75% of that loan amount as your upfront fee. For conventional, it's a little bit more in depth. So if you have a better credit score, and it also depends on your down payment as well. So better credit score and a decent down payment is going to get you lower mortgage insurance than lower credit score with lower down payment. So if you're only putting 3% down, your mortgage insurance might be $200-$300. But if you put 10% down or 15% down, your mortgage insurance might only be, $20-$30. So it does make a difference what your credit score is. It does make a difference of, how much money you put down. Even if it's, if you are putting down 5%, put down 5.125%, because it's just over that 5% mark. It'll make a huge difference in what do you pay in mortgage insurance.
Okay, noted. All right, you can continue with the title fees.
Okay, so that was the mortgage insurance there. If you look down underneath the mortgage insurance, you'll see the appraisal fee, $585, credit report fee. So when we pull your credit, you do get charged for that. Flood certification to make sure, again, your property is or is not in the flood zone. They do charge for those things. Lender's title insurance and the owner's title insurance. These insurances are to protect your title against people that have claim to your property or that make claim to your property. So we as a lender and you as an owner of that property want to make sure that if somebody comes down the road and tries to forge something, or somebody says, oh no, I have ownership rights to that property, that you are protected and that nobody can just go and get a copy of your title and assume your ownership of your property. So that's something that, is required in the transaction. Transfer taxes. Now, not all states require the buyers to pay transfer taxes. So New Jersey, the seller of the property pays all the transfer taxes. Now, sometimes buyers in New Jersey will offer to pay the transfer taxes, kind of to sweeten the deal for the seller, because then, they'll make more money on the deal, and pay the transfer tax. But New Jersey, in general, across the board, the buyer does not pay any transfer taxes. In Pennsylvania, it is a split between the seller and the buyer for the transfer taxes. So this is a deal that is in Bensalem, Pennsylvania. So the transfer taxes are split between the seller and the buyer, and that is the buyer's portion of the transfer taxes at $3,000 there. Underneath that is the recording fees. Recording is just recording that the title and the deed and everything like that with the county. That is something, again, that you have to pay for as well.
All right, let me go to the second page. All right.
Second page here. So this is what I was talking about as far as the escrow account is concerned. So every mortgage payment is made up of what is called the PITI. It's principal, interest, taxes, and insurance. So you have your principal portion of your payment, the interest that is charged in your loan every month, the taxes of the property taxes of the property, and the homeowner's insurance. That is what a basic mortgage payment is comprised of. So what we do as a mortgage company is we collect every month 1 month of your homeowner's insurance amount and 1 month of your tax amount. So in this instance, we used $600 a month for the taxes, $150 a month for the homeowner's insurance. So what we do when we set up a loan, we collect an extra 2-3 months of homeowner's insurance, extra 2-3 months of taxes, and then we're also going to collect for 3 months of taxes and a full year worth of homeowner's insurance at closing. And the reason for that is there's a quarter's worth of taxes that may be due at closing or that may not have been paid. So we want to make sure that if the seller needs to be reimbursed for any taxes that he's paid for the time that he's lived in the property, that he gets reimbursed for that. And if there are any taxes due in the next month or 2 months or so, that we have the ability to pay those taxes out on time and establish you a proper escrow account so you're not short in your escrow account. Because if your taxes become delinquent, somebody else can lay claim to your property. You don't want that. Right. So what the mortgage company does, we make sure that your escrow account is stacked enough that we can pay out your taxes at closing, we can pay out the homeowner's insurance at closing, and then we establish that escrow account of 2 or 3 months of homeowner's insurance, 2 or 3 months of taxes, so that the following year when your taxes are due, we can go ahead and pay them out for you again. And then again, the way that escrow account builds, every time you make a mortgage payment, that $600 and that $150 worth of homeowner's insurance and taxes go into that mortgage and go into that escrow account so that they're paid out the following year. Okay. You'll see down here on the right-hand side underneath where it says prepaid interest. Prepaid interest is interest that you'll pay on the loan from the day that we close the loan until your first mortgage payment or until the first of that next month. So mortgage interest accrues in arrears. So they can't. They're most of the time, you won't, when you get a mortgage and you close, we can't charge you a payment until 30 days goes by, because that interest has to accrue before we can charge it.
Mm-hmm.
So what we'll collect for is the time from the day we close till generally the end of that month. And then again, the full month of interest is going to collect, and you'll pay that on the first payment of that new loan. But from the time that we close until the time of the first date of that next month, that's what we collect that interest for.
Okay.
Okay. So again, you'll notice, if you close on a home loan, say, you closed on May 17th on a loan, you won't have a first mortgage payment until July.
Right.
Of the following month, the first month, July 1st. So the time from now until the end of this month, that's what we'll charge you the prepaid, the per diem interest on, and then that other interest will be accrued and paid on your first payment. So down here at the bottom where it says cash to close, you see it says down payment $10,500. That is the $300,000 purchase price at 3.5%, and that's $10,500. Closing costs, that $13,005.75 that's on the screen. That is the fees that were on the previous screen, as far as the title fees, all the lender fees, the appraisal, and all those things. Plus this, the mortgage insurance upfront premium is including in that that closing cost amount. Mm-hmm. All right. And then you'll see the prepaid items listed separately. So the prepaid items are $6,365, and that is those fees at the top there. And if you look in the right, sorry, go ahead.
No, that wasn't me. My daughter is in the room and dropping stuff.
And then you'll see in the right-hand column here, it says finance mortgage insurance premium. And you'll see that $5,066 that we were talking about on a previous page. That is included, like I said, in this closing cost number, but because it's in this other column here as finance, that's not in your final estimated cash to close number at the bottom where it says total estimated cash to close.
Okay, that's 25 right here.
Yeah, 25. Oh, I'm sorry, I said 29.
No, I said 25. I'm saying
25,039 was the end number there. So now, are there other fees that could be, included in your closing costs? Absolutely. So if you have an attorney that's added to the deal, that's going to add to your closing costs. Other settlement fees from the title company, because when we are doing loan costs for an estimate for you, we don't have the exact title company that you're going to use. We normally don't get that from you until you guys go under contract and either you and your realtor have discussed that and have decided on the company to go with. So again, their fees may differ a little bit from ours. So that's why this is just an estimate. Generally, my rule of thumb is, if I'm giving you a number of 25,000, that's fine to have. Give yourself a buffer of anywhere to, $3,000 to $5,000, because what happens at the end of every mortgage transaction is we balance out our fees. So I was talking earlier about if we had to reimburse the seller for anything. So the seller pays all of the utilities on that property. Mm-hmm. So at the end of our transaction, if you're going to be taking over in the middle of a quarter for a seller, and he's already paid taxes, he's already paid the water and stuff like that on the property, he has to be reimbursed for those things. And then there's certain things that, the title company gets from the county that need to be charged, or the real estate fees or the attorney fees, things of that nature. All those things aren't settled out until maybe a day or so before closing is taking place. So there could be a situation where your closing costs could come in under that 25,000 that's on that page, but there may be also be a situation where it comes in a little bit over. So I always tell everybody, give themselves a little bit of a buffer, because there's always a possibility of it going up or down by the time we close. We get as close as possible as lenders. And we have to be, tried and true on some things. Some things we can't change, but the things that we have no control over can change. And those things that we have control over are like the title fees and, fees that are coming in from the lawyers and stuff like that.
All right, cool, man. And I usually tell people when they ask me, it's like, okay, how much is this going to cost me? I usually tell them 10%. I'll say, listen, it's not going to be 10%, but if you have 10% of the purchase price, then you'll be good. You'll have over what you kind of need, but that's a nice clean number that I give buyers as far as, well, how much am I going to need to buy this home?
Mm-hmm. And that's a good rule of thumb. I know some agents that'll say, your closing costs are going to be 2 to 5%, and your down payment is 3.5%. So you combine them together, and that's what you'll need. It's different for me as a lender because, again, I'm going to tell you just, hey, this is what our numbers are. This is what it looks like, and so I try not. Again, just for me, I try not to give people, hey, this is 10% or this is this percent. This is what you need. And kind of what we were talking about earlier. If you don't know how much to save for a mortgage, or you don't know how much you're going to need, find out. Because you need to instill a couple things. You need to make a budget. You need to make a savings plan. Figure out how you're going to get to that goal. You need to find out if the company offers down payment assistance. Because again, your house you might need $25,000 to close, but if a down payment assistance program is going to give you 10,000 of that, now you've cut your goal almost in half. You only need 15. So it's very important to find out what you need, what you qualify for, what the costs are, and go from there.
All right, man. Well, we're gonna wrap this up, man. Are there any programs that you do want to highlight or kind of shout out before we close this down?
Yeah, I mean, especially if you're in the state of Pennsylvania, Pennsylvania has the PHFA, which they offer 5% towards the purchase of your property on their KFIP program. New Jersey has the $10,000 program that they'll give you $10,000 towards the purchase of your property there. All these programs do have credit score minimums. But those are all things that are offered. The Chinoa program offers you 3.5 or 5% down payment assistance as well. There's a ton of programs that would benefit borrowers. But again, like I said, you want to definitely reach out to if you have a lender that you're working with, reach out to that lender, pick their brain. And if they don't offer any down payment assistance, just know that it's out there. There's county grants in a lot of these different counties. Philly, I know it's dried up now, but Philly just had the front door program. Was giving $10,000 to people. But these programs, when you hear about them, jump on them because they will dry up quick. Because there's only a set amount of money for some of them. And you'll be, again, if you wait, you blink, you'll miss it.
Yep, and that's what I tell people all the time. Like, look, it's not an ocean of money; it's a pool.
Mm-hmm.
And then once that pool is dried up, it's done. And they're not going to warn you and say, hey, this is about to done. They're just going to shut it down.
Yep.
So, I always tell people that, man. All right. Well, listen, man, we want to thank you. All of Andrew's information will be in the description. So if you guys are looking to get pre-approved, definitely reach out to him. And he definitely has our stamp of approval. And hey, guys, I see you on this next week, man. Andrew, thanks for coming on.
Thanks for having me, man. Appreciate it.
All right, no problem. All right, y'all. Till next